Subdivision 328-D provides a simplified capital allowance system for small business entities. The system is optional to enter and has two main methods of claiming deductions: the pooling method or immediate write-off for low-cost assets. The first thing we need to consider then for this provision is whether the taxpayer is a small business entity or SBE. A taxpayer will be an SBE if it carried on a business during that year and satisfied the $10 million aggregate turnover test. Small Proprietary Limited elected to use the SBE capital allowance system during the income year just ended. The asset register items are used 60% for earning assessable income and 40% for exempt income. To enter the SBE capital allowance system with existing assets, Small must quarantine existing low-value and software development pools. That is, no new assets are allocated to these pools. All of Small's existing depreciating assets that were installed in a previous year and not in a pool are now allocated to the SBE pool. They are included in the opening balance and get the full 30% diminishing value rate. So, the taxable use proportion of the machinery opening adjustable value, or OAV, is allocated to the SBE pool opening balance and has a 30% decline rate. Assets in the low value pool are not allocated, and the decline in value is calculated as per normal for a low value pool. That is 37.5% of the opening adjustable value. Now we consider the situation where Small purchased two assets during the year, with asset 1 costing $28,000 and asset 2 costing $18,000. Both are estimated to be used 60% for taxable purposes. Asset 1 cost more than $20,000. Therefore, 60% of its cost, that is $16,800, will be allocated to the SBE pool. This will form part of the opening SBE pool balance next year and receives a decline rate of 15% this year. Asset 2 is a low-cost asset as it costs less than $20,000. Therefore, it is not allocated to the SBE pool. Small is allowed an immediate deduction for the taxable use percentage of this asset in accordance with Section 328-180 subsection 1b. That is a deduction of $10,800, which is 60% of the $18,000 cost. We should also note that where a low-cost asset is not initially pooled, and its adjustable value is zero after the cost is deducted, then, if in a subsequent year an amount less than $20,000 is included in the second element of cost, then an immediate deduction is also allowed for this for the taxable purpose percentage. However, this is only for the first occurrence in a year after installation. So if Small was to make a cost addition of $100 to asset 2 in a later income year, then an immediate deduction of $60, which is the 60% taxable purpose, is allowed. However, if instead a cost addition amount of $21,000 was made, then the asset is allocated to the SBE pool with an adjustable value of $12,600. There will be a decline rate of 15% applied to this in the year it is allocated to the pool. To work out the closing pool balance, we take the opening pool balance, add the taxable purpose percentage of allocated assets that year, and cost additions to pooled assets. Then we deduct the taxable purpose percentage of termination value for assets in the pool, deduct the decline of 30% of the pool opening balance, deduct the decline of 15% of allocated asset values this year, and finally deduct the decline of 15% of any allocated cost additions this year. Note that if the termination value takes the closing balance below zero, then the surplus is included in assessable income. We now have to consider the pool closing balance. If the closing balance under a simplified calculation, ignoring decline, is less than $20,000 but greater than zero, then an immediate deduction is available for this balance. This is instead of claiming deductions using the normal method. This means that they deduct the simplified balance and obtain a zero pool balance, rather than calculating the decline in value and deducting over time using normal pooling methods. To recap, the key points to remember with the SBE capital allowance system are that it is optional. The primary method used is pooling. However, low-cost assets and low pool balance may be deducted immediately.